one of the things that's also been impacting investors are bonds, the seesaw there of interest rates moving up and bond values moving down. So, bonds for the past 30 years have been in a different world where interest rates have gone down for past few decades, and so bond values were going up. So kind of like a bull run.
Yeah.
I think we have some reversal of that for the next couple years. I won't predict beyond that because I believe we're in a world where they're just not going to push interest rates up too much. Now, I am on the side of I think the markets should control interest rates versus the Fed. Let the markets dictate the flow of that. And the market is going to want to push interest rates up. I can see how this looks here. So we're at 10-year Treasury of 2.904. So we had a 0.014 yield change. Here's where I think normalization looks a lot better. And I think I like to be in a world where we're kind of at a 3% 10-year Treasury. I don't know where they push it to, but the Fed rate they raised, but are they going to push it up a lot? No, because they might turn around and have to give it back because if they don't get to some normalization. But in essence, you also, on 10 years, you have the market actually adjusting that from where it was recently. Other part of the conversation, let's see, where are we at? Let me just look at the 1 year there. We're kind of 1 year ago, we're essentially at 1.64 and we're at 2.9. So we're not far from having double that rate. If we looked at, say, August of last year, it was at 1.1 and now we're at 2.9. So if we look at 3 years, 3 years ago, we were at a 2.54. So I like us being right there at about 3%. I don't know how much further up it will go, and it may go up some more. But once again, we're a leveraged world. Everybody lives on borrowed money. You leverage money to buy your house. You probably leverage some stuff with credit cards. And consumers built on borrowing short-term money as well. Oh, our government lives on borrowed money, and they're not going to want to pay a lot of interest rates as well. So after World War II, pre-World War II, we were a society of we just pay for everything as we go. If you don't have the money, you didn't get it. And then we became a leveraged society after that with low interest rates. And I think that's part of where there is almost so much tolerance for the upside of that. So with that said, I believe, here's how I believe portfolios are best balanced from asset classes. I think you should hold some stocks, knowing those things move around and they upset people because every couple years we get a 10% correction. Every decade we get a 20% or more correction. And sometimes, and it's not a lot, but we get a 30% or more correction in there. So what's problematic? I think it's problematic if you put all of your money in stocks. And stock selection can be rough. You could be a big Disney fan, but they're off like 25% this year. They've kind of become a little unpopular of late. Netflix has been a tremendous investment the past decade, but lately it's taken a hit.
Yeah, it's
there.
2022, it's down 64%.
So if you were building your own portfolio and doing stock buying, you might say have 50 stocks, and if 2 of those are in there, ouch, that hurts your portfolio. And one thing we find history also tells us, and that was Hendrik Bessembinder, I believe he's a professor of finance, but he wrote this research piece a few years back, and basically do stocks outperform treasury bills? And what his research found is most stocks do not outperform 30-day treasuries. So, but his research also found that using indexes skews a higher return. So with that said, I lean towards that as a tremendous foundation and philosophy of, yeah, you shouldn't have all money in stocks, and if you're stock picking, are you going to be diversified enough? Have you picked the right ones? And do you have the momentum stocks, meaning what's in favor? Remember, everything rotates there. So are you going to be in a situation where you get hurt? And are you investing in a way that you are going to emotionally interrupt the compounding of your money? That worries me. So if you're going to make a disruptive decision, are you putting too much at risk? So the other thing is, I like me some bonds, but I also don't want to go buy individual bonds. I would rather use an institutional portfolio. I'd prefer exchange traded funds for efficiency to do that. But with that said, we know if interest rates move up, bond values don't. So what would we do in that situation? We would adjust bond holdings. Our institutional partners will have gone in and made adjustments to have the bond portfolios less impacted by interest rates moving up. So when people are concerned about that, and we have people reaching out to us about that, and our guidance is we've already made those adjustments. Now, there's some other things we've probably made recommendations to that have not been followed, and they're going to need to do that because existing clients may look a little bit different than new clients. And one is new clients. We also add quantitative tactical in the mix. And you want to define?
Yeah, basically what we want to look at is data. We want to follow the data on where is the momentum of the market. And if we need to shift momentum because the data is showing there's a problem, we need that money to shift and go to what's working and what's in favor. Because what you mentioned about what's in favor, what drives the market, I kind of think of momentum like the wind. It might be gusting one way for a long time, but it will shift. And we want some money that has the capability to do that with us to get through these kind of issues where inflation has concerns, where stock market and interest with bond values have concerns. We need to have some money that can react to that as well.
You said it very well there, and we want money to follow momentum. In extreme situations, and even for short periods, some portion of that block can shift to cash.
Correct.
As it awaits where momentum is shifting to. And we like, and that's a great way to define it, is we utilize a lot of data throughout every day, all day, to give guidance on where that goes. And the neat thing about it is we use data for fundamentals of why we use asset classes, but we also want to use data, which is the modern capability. It's kind of like, I don't want those nuclear machines taking pictures of my body and finding out what's wrong and running all these tests, just, listen to my heart and take my temp and use one of those x-rays that light me up and tell me what's wrong. No, we want to use the most modern data technology that we have to help our money. And we also look at history to tell us what skews better returns. And the whole point is we're not doing something and forgetting about it. We're making adjustments as we go.